Good afternoon and welcome to another episode of Sheriff's Podcast. Today, you'll be joining me in this discussion on insights and analysis with yours truly, Joel Bhagwandin. In today's episode, I would like to turn our attention to the small business sector and to discuss the government policies aimed at promoting the growth and expansion of SMEs, small and medium-sized enterprises. This, the issue of financing constraints and other constraints that SMEs faced have, have always dominated our business forums and topical issues in the business sector space and policies therein. Access to financing, cost of capital, lack of innovative and modern instruments and financing solutions have always been topical and dominant in this sphere. So this afternoon, I'd like to look at this sector, walk you through some of the initiatives and policies that the government, the PPPC government that is, would have implemented over the years. What were the impact of those policies and what are their future plans targeting this sector, the small business and medium-sized enterprises sector, right? And of course, we can't have that discussion without exploring and discussing the challenges. I have here a list of questions that I will attempt to answer that would help me to give pointed answers to some of these issues that I've alluded to broadly in my opening remarks. The first question is, a common complaint from businesses, particularly micro and small enterprises, is a limited access to finance. How has this situation evolved over the past years, and what initiatives have been implemented to bring about this change? So, first question, access to finance. Recognizing, in fact, before I touch on government policy, it would be remiss of me not to recognize firstly what private sector actors would have done outside of government intervention. In Guyana, there is one microfinance institution that was founded since around 1986. That institution is called IPED. IPED is a microfinance institution. And why I'm pointing this out is because microfinancing is very different from different types of financing like commercial financing, corporate loans, etc., that more mature, the larger entities, larger corporations and more mature corporations would be able to easily access, although there is a collateral component as well. Microfinancing is very different. It's very different, it's more costly, and I'll explore with you why it's more costly in a few moments. So, recognizing the need for microfinancing, recognizing the importance of small businesses, this institute called IPED was formed way back in the late 1980s. From then to now, this institution would have contributed significantly towards the development and the development, the building and creation and sustainability of SMEs in this country. The last annual report that I looked at, on an annual basis, they administer on average about 4,000 loans. Presumably that's 4,000 different small businesses in a year. And those small businesses eventually graduate towards becoming medium-sized and then large, and then they become mature. And then eventually they grow out of the capacity of IPED that they could lend and then start to access funding at the commercial banks. So it's important for me to acknowledge and recognize the contribution of IPED and to explain the role of a microfinance institution such as IPED and how is it different. It's different because most of the challenges or the key challenges that small businesses encounter that inhibit their growth is their lack of capacity in key management areas, lack of training in management, lack of training in accounting, record keeping, financial management, and that type of capacity building and how to properly manage an entity, build, grow, manage, and sustain an entity. And so this institution is designed in such a way that it provides that sort of support, it provides that sort of training, and in the administration of funding, to these to small enterprises, it takes a very integral role, or it plays a very integral role in monitoring the disbursement of funds, monitoring that the funding channel to this business or the funding placed into this business, it is used for what it was intended. They assist in managing and ensuring that it is managed properly, and they ensure that the desired result therefrom, that it is achieved through training and so on. And so those are the key features or differences that makes a microfinance institution very different. Its role is very different from that of a commercial bank per se. Commercial banks are set up differently. Commercial banks by design and by their very nature, they're very different. They're not, commercial banks take depositors' money, and so they have a responsibility to safeguarding and securing depositors' money that they then take to lend to businesses. So their operations is very different and they're more heavily regulated. The interest rate that you would find for loans, or microfinance loans, would tend to be higher than the market rate, and that is because that the microfinance institution is taking a greater risk in lending to ensure that your entity grows, that it is successful, and because of the collateral limitation. Most microfinance small businesses, they do not have adequate collateral to access funding at the commercial banks, and hence institutes other sources of finance such as IPED. They take inventory and other things that the banks traditionally would not be able to take as collateral, but because of the risk involved in those type of collateral, the interest rate is higher. But in the long run, you're able to accumulate more assets, and you're able to grow into a more mature business, a more mature company, a more mature enterprise. And in the long run, you de-risk your operations. You then become eligible for cheaper sources of financing and larger value of financing based on the scale of your investment. So that's the first that I want to acknowledge in this space of microfinancing and small businesses. Now, similarly, recognizing the importance of small businesses in the role they play in terms of the growth of the economy, in terms of serving as a source of job creation and a source of income for families. The government, the PPPC government, had created what is called the Small Business Council, vis-a-vis the small business legislation. Pursuant to that legislative enactment of the small business legislative framework that created the Small Business Council, an agency was developed pursuant to the 2004 Act. An agency was developed which is called the Small Business Bureau. So since in the early 2000s, in terms of government and government policy, the government had created the Small Business Bureau, created the legislative framework, created the Small Business Bureau. The Small Business Bureau is an agency that is allocated on a yearly basis financial resources from the Treasury, and that which is in the range of, I think, is over $1 billion or $2 billion. And that agency manages that fund, which is replenished every year through the budget. Their funding is replenished every year and to grow incrementally as well. It operates similar to that of what is called a revolving facility. So some of the funding resources are used to distribute grants to small businesses, and then some of it is used to administer loan facilities through the commercial banks. And so the way the loan works is through the commercial banks. The commercial banks, the Small Business Bureau would handle the application and process it to ensure that your loan proposal, your loan request meets the established criteria, the established conditions. They then approve it. You then go to one of the commercial banks and you're able to access low cost funding with considering too that you have collateral limitations. You may not have adequate collateral. You may have some collateral, but on your own, your collateral, if you go ordinarily to the bank would tell you that your collateral is not sufficient to cover your loan amount, the value that you're asking. So you go to the Small Business Bureau, you take whatever collateral you have, and the Small Business Bureau, through that arrangement between the banks and the government and the agency, they guarantee 70% of the loan. They guarantee 70% of the loan. So which means your collateral only needs to cover 30% of the loan. 70%, this funding is used to guarantee your loan at the bank, 70%, which means 30% of the collateral that you only have to put in 30% of the collateral value. This is a mechanism, a government policy mechanism and tool through which they have successfully over the years, since the establishment of this bureau, administered low-cost financing, made available low-cost financing, below market rates financing for small businesses. This is a major policy of the government in this regard. The second question is, micro, small and medium enterprises also face challenges related to training and mentoring. What measures are being taken to address these issues? Important to note, as I've alluded to in answering the first question, that IPED is a microfinance institution that is set up in this manner to provide training and mentoring. But it is not only a responsibility for the government. The government of the day is providing all of the resources, ensuring that enabling environment, ensuring that the policy environment is there, and actively over the years introducing new initiatives, new policy initiatives towards the facilitation of small and medium sized businesses. With that in mind, training, mentoring, capacity building is also a function of the private sector. And there are many agencies and BSOs, the business support organizations, that are available that provide this sort of mentoring and capacity and training opportunities to help small businesses. So those are the main challenges and the avenues that are available, the options that are available, the resources that are available, the institutions that are available to assist with mentoring and training of small businesses. Recently, the University of Guyana, which is now free, which is now state-sponsored. A few years ago, the University of Guyana introduced an entrepreneurship school. So this is an example of government participation in that regard. And of course, all the other training in technical areas, TVET training, and all the other scholarships and free tertiary education, those are also geared towards promoting better training and access and mentorship to small businesses again. So you have to take that into account. Now, how has, if we look at the growth of small businesses over the last 5 years, the statistics would show that the growth in small businesses over the last 5 years have been exponential growth. And when I say exponential, over the last 5 years, if you check with the deeds and commercial registry, more than 60,000 new small businesses were registered. More than 60,000 small businesses were registered. That is testimony to the fact that the economy is generating the opportunities to support their existence and their sustainability. The economy is generating those opportunities for small businesses. Let's look at some of the key performance indicators. The Procurement Act. This is another policy tool of the government, again by the PPPC government, enacted by the PPPC government. The Procurement Act provides for a minimum threshold of government sector, public sector contracts that must go to small businesses, and that minimum threshold is 20%. Between 2020 and 2025, more than 20% of government contracts have been awarded to small businesses. More than 20%. In fact, it is about 80% or more. 80% or more of government contracts have been awarded to small businesses. To give you a better perspective in this, over the past 5 years, over 6,300 contracts were tendered. Over 6,300 contracts. During this time, over 2,000 new businesses were registered in the public sector system that would have competed, tendered for, bid for, and awarded contracts. Of the 6,300 contracts awarded, with over 2,000 new businesses registered, small businesses registered, what we would classify as small businesses. 80%, more than 80% of those contracts have been awarded to small and medium-sized businesses of the 6,300. This is in the public sector alone. In the oil and gas sector, as a result of the enactment of the local content legislation, that legislation has contributed to more than another 2,000 local companies, mostly small and medium-sized companies, locally owned, actively participating and have active contracts and supplying goods and services in the oil and gas value chain. That is annually nearly 800 million US in additional revenue from the oil resources. Again, that would not have been possible without intentional, deliberate government policy which was administered vis-a-vis the local content legislation. That piece of legislation led to that result. I've given you 3 indicators so far. Fourthly, if we look at our tax data, income tax data, between 2015 to 2025, self-employed persons using income tax that they paid and using income tax to extrapolate and calculate their gross profit, given that we know what would be the effective tax rate, self-employed persons' gross profit have risen from $13 billion from 2015 level, 13 billion, to in excess of 20 billion today. $20 billion today. If you look at the total private sector credit, that has more than doubled from 2015 to now, more than doubled from 142 billion in private sector credit to over 300 billion, over 308 billion private sector credit. So these are indicators statistically to demonstrate the accomplishments, the achievement of government policies, deliberate government policies. I've outlined that framework, what that framework looks like, the Small Business Bureau. I've acknowledged what the private sector does, existing institutions that are private sector driven. I've outlined the government policies vis-a-vis Small Business Bureau Act, the 20% threshold, government contracts awarded, local content legislation, the gross earnings of self-employed using the income tax data, and small new businesses registered in the last 5 years, more than 60,000 small businesses registered. These are remarkable indicators of success. These are remarkable, notwithstanding the challenges, and you hear people still complaining about access to financing and so on. But there is always 2 sides to the story of access to financing. On one hand, those are some legitimate concerns which I've briefly alluded to, but then on the other hand, the lack of proper training, the lack of proper record keeping, accounting and financial management capabilities, knowing how to manage your financial resources, not misappropriating or misusing financing that the banks or financial institutions make available to you, not taking money from a business to excessively expend on personal effects, or withdrawing money from the business to finance personal expenditure, taking short-term financing, taking money from your short-term financing to finance long-term assets and that type of stuff. So a lot of it not being able to present a proper business case, of developing a proper business proposal and conducting a proper financial and economic feasibility of your project or your investment. These are the limitations as well that prevent you from accessing funding outside of issues of collateral constraints, outside of the lack of modern financing solutions, modern tools in our market. Yes, there is a considerable need towards deepening our financial market and getting our financial market to a place where it's more advanced. There are other types of instruments available, other types of financing solutions available, different types of institutions to bring different types of financing solutions. That is, yes, that is true. But on the other hand, these are the other facets as well that have to be addressed. So it's not an issue of government policy alone to tackle. Having said that, as it's already 30 minutes into the program and I don't want to go beyond 30 minutes, I'll end by briefly sharing my views on the outlook for the small business sector. The outlook, of course, with what I've just described to you and outlined to you, one of the key things in terms of outlook that we know for sure that the government has already committed to is the introduction of a development bank, a development financing institution, an indigenous development financing institution in their next term that will make available interest-free loans, specifically targeting the small businesses and the small business sector, to grow those sectors, making interest-free loan available. Now, of course, with that addition to the market, it will, of course, have a huge positive impact for the small business sector as far as access to financing and cheap source of financing is concerned. It will definitely have a huge impact. But I want to conclude on a note to respond to the critics of government, more so a certain segment of their opponents who are contesting the election and who said when this announcement was made, why only now? Why they couldn't do it 20 years ago? Why they had a long time to bring a development financing institution? Why they only doing it now? And some of them are saying that this is an election gimmick. It's not. As far as, and I can tell you as a professional, a finance professional, as far as the PPPC government is concerned when it comes to their commitments, I don't want to say promises, I want to say commitment, none of it is election gimmick. They're all serious and they have proven that they have what it takes to deliver on them. On the question of timing, however, I want to particularly address that in responding more or less to the opponents who are contesting the election. Context and history is important. Context and history and financial soundness or financial literacy is important. If you study our economic and political history, you will learn that a development financing institution is not new in the Guyanese context. We have had, under the dictatorship days under the days of the Barnum regime, when we became practically a bankrupt country under the Barnum leadership, under PNC rulership. We've had a development bank called Bank, Guyana Agricultural Bank. And the bank failed. It failed to the extent where it went bankrupt. And so when the PPP won the first democratic election that was held in 1992, and they inherited a bankrupt economy, and they not only a bankrupt economy, they inherited bankrupt institutions. And so they had to liquidate that institution. So that is the first point to note as far as development financing institutions are concerned in the Guyanese historical context, historical, political, and economic context. The second point to note, why only now, is that from the days of bankruptcy, when they inherited a bankrupt country with bankrupt institutions, it took us decades. It took us 2 decades to get it to put back the economy. In the 2000s, when we exited the IMF program, it was not until around 2006, when we exited the IMF program, that the economy was restored to an economically viable economy, economically and financially viable economy. Not until 2006. So from 1992 all the way, when I'm talking about the period the PPP inherited the economy, from 1992 all the way to the 2000s, more than 100% of revenue collected in taxes were used to service debt. So where would you get the money to recapitalize and reintroduce a development financing institution? So the financial resources was not available 30 years ago. The financial resources, because of these historical events and historical facts that I must remind you of. Thirdly, I mentioned 3 things. The third that I mentioned is financial soundness, financial and technical soundness. Is that you can't take, if let's say 5 years ago or 10 years ago, government wanted to reintroduce a development financing institution, because the private sector has been advocating for the reintroduction of a development funding institution a long time, a very long time. But the way development financing institutions work, you have to understand that a development bank, the function and the role of a development bank, and the function and the role of a commercial bank, and the function and role of a micro lending institution, they're all different. What are the differences? Commercial banks, their source of capitalization, their source or sources of capitalization or sources of funding is depositors' money. Their source of funding is depositors' money, and therefore commercial banks have a responsibility, regulatory requirements to protect depositors' funds. They can't, when I say depositors' money, your savings, my savings, everybody's savings. So you would not like for an institution to take your hard-earned savings for years and lend it out to John Public and Jim Jones and can't recover that money, and your savings gone. Your life savings gone. This is what essentially commercial banks are involved in, because their source of capitalization, their source of funding is from the depositors, which is you and me, our money, our savings. And so they're heavily regulated. And so they have to be, by design and by their very nature, they have to be more risk averse. Microfinancing, I explain the role and function of microfinancing and how they are designed and how they are set up. And their source of funding is also very different. Their source of funding is not household savings. Their source of funding is from their shareholders and from their members. Development bank, coming to development bank or development financing, their source of funding. And why I'm telling you this source of funding, because source of funding determines the cost of financing, and that determines the risk appetite of these type of institutions. Development financing, their source of funding is not from depositors. Their source comes from governments. In this case, it would be, I presume it would be government revenue from taxes or oil revenue, and or it comes from multilateral lending agencies such as the IDB, CDB, World Bank. So, so development financing, 10 years ago, if we had, with that in mind, 10 years ago, if we had introduced a development bank with money from borrowed capital from the multilateral agencies, you're borrowing at a rate, you're borrowing at a cost. So you can't borrow at 3%, you can't borrow the money at 3% and then off-lend it in the market at zero interest. So cost and source of financing is another factor, or was another factor. And that is why we couldn't have it 5 years ago or 10 years ago or any time in the last 30 years. Now we have the resources. Now we have the financial resources. And now our own financial resources, we could take and capitalize a development financing institution. And we can, because we're not borrowing this money from, we don't need to borrow it from anybody or any multilateral agency. And that is why, because it's our own resources, it's a cheaper, obviously a cheaper source of funding. And therefore, that is how the government is able to make this commitment that we will introduce a development financing bank in the next term to offer interest-free loan. And what is the role of a development bank? A commercial bank is to lend to existing, is to sustain commercial lending, commercial banking is to sustain existing industries and to grow existing industries, meaning to lend to existing businesses to expand and to finance their working capital. Development banks, development financing is different. Development financing is to fund new industries, the creation of new industries and to fund the growth of new industries. And so the 60,000 small businesses that we talk about, this development financing institutions will serve them interest-free loan to create new industries, new sources of income, and to grow them to a level that it becomes sustainable, and then they could move off and go on to accessing capital through other sources such as commercial banks over the medium and long term. So with that, thank you for watching us. Thank you for tuning in. This brings me to the end of today's discussion. Catch you on the next episode.